When a customer walks into a retail store, swipes their card, and walks out with a product, accounting for that transaction is straightforward. The company recognizes all the revenue from that sale at a single point in time. The exact moment control of the good transfers across the counter. But consider a heavy civil contractor building a multi-million-dollar bridge. They aren't handing a finished product across a counter. Instead, control of that massive asset transfers to the customer continuously, girder by girder, over months or even years. Because the performance obligation is satisfied over time, the accounting rules mandate that the contractor must also recognize revenue over time. To do this accurately, the company needs a reliable way to measure exactly how much progress they've made toward completing that obligation at any given point in the project. There are two primary frameworks for measuring this progress. Output methods look at direct value transferred, like physical milestones reached or units delivered. Input methods look at the resources the contractor has consumed, like labor hours expended or, most commonly, costs incurred. Choosing the appropriate method ensures the company's financial statements reflect their actual economic performance in delivering the asset, rather than just mirroring arbitrary billing cycles. For long-term construction contracts, the most frequently used input method is based directly on costs incurred. This cost-to-cost method divides actual costs incurred by total estimated costs to find completion percentage. But the numerator is strictly guarded. Costs from inefficiencies, like wasted materials, are excluded. General, administrative, selling, and marketing expenses are similarly blocked from the calculation. The numerator must be tightly guarded. It can only contain costs that genuinely advance the physical transfer of control to the customer. Let's look at how this math executes in a multi-year construction project. Looking at this source example, a contractor agrees to build a bridge. The total contract price is $2 million, and they expect the total costs of the project to be $1.2 million. By the end of year one, the contractor has actually incurred $300,000 in qualifying costs. We plug those figures into our cost-to-cost formula. We divide the $300,000 in costs incurred by the $1.2 million in total expected costs. That tells us the performance obligation is exactly 25% satisfied. We then apply that 25% completion rate to our $2 million total contract price. This means the contractor recognizes $500,000 in revenue for year one. Under this method, the cost of goods sold recognized for the period simply equals the actual costs incurred. Subtracting our $300,000 in COGS from our $500,000 in revenue leaves a clean gross profit of $200,000 for the year. Year one establishes a mathematical baseline, but this relies on the assumption that expected costs remain perfectly static, a scenario exceedingly rare in complex construction. As long-term contracts progress, material prices fluctuate, delays happen, and initial estimates inevitably change. When these accounting estimates shift, the rules require companies to handle the changes prospectively. They do not go back and restate prior periods. Instead, they adjust the math moving forward. Fast forward to the end of year two. Looking at the updated data, total costs incurred to date have now reached $900,000. But more importantly, the contractor now expects they will need to spend another $600,000 to finish the bridge. Adding the $900,000 already spent to the $600,000 expected pushes our total expected cost up to $1.5 million. We run the formula with our updated numbers. $900,000 divided by the new $1.5 million denominator means the project is 60% complete. Next, we determine where our cumulative revenue needs to be. Applying the 60% completion rate to the $2 million contract gives us a $1.2 million target. Since the company recognized $500,000 in year one, we subtract that out. This leaves exactly $700,000 in revenue to be recognized specifically for year two. After deducting the $600,000 in costs incurred during this period, the year two gross profit sits at $100,000. This prospective adjustment ensures that the current period's income statement absorbs both the actual physical progress made during the year and the mathematical correction of the altered cost estimate. There are situations where a company starts work on a contract, but they lack the historical data or clear visibility required to reasonably estimate total future costs. When progress cannot be reliably measured, but the costs are expected to be recoverable, the entity relies on the extent of costs incurred method, commonly called the zero profit margin approach. In example 5-3, Sadiq Company cannot reasonably estimate final costs. However, they incurred $300,000 in recoverable costs in year one. Therefore, Sadiq recognizes revenue at the exact dollar amount of those costs. Revenue and cost of goods sold are both logged at $300,000. Because revenue directly matches expense, zero gross profit is recognized for the period. If an entity lacks the visibility to predict their final margin, they cannot claim one. They are only permitted to protect the balance sheet by recognizing recoverable costs until the project's final outcome comes into focus. While long-term accounting allows for adjusting estimates and zero profit margins, there is one final overriding constraint that governs every contract. As the note at the bottom of this text states, as soon as it becomes apparent that a project will result in an overall estimated loss, that total loss must be recognized in full immediately. This rule applies universally. It does not matter if the entity is using an input method, an output method, or the zero profit rule. Accountants cannot use percentage of completion calculations to defer bad news or artificially spread a known loss over future reporting periods. Recognizing revenue over time requires a continuous balancing act of tracking physical inputs and refining cost estimates. But all of that math remains strictly bound by the conservative mandate to never delay reporting a known loss.